and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, head of non-dollar rate strategy, and I'm joined today by our global market specialists, Kevin Cummins and Joann Spadigam. Okay, let's start with the US again this week because I think, like the last couple of weeks, it's really been the data and, of course, the Fed this week that's been driving markets. So, the long-awaited Fed meeting that came after a couple months now of stronger than expected data. Kevin, what were your key takeaways from Chair Powell yesterday?
Yeah, there really weren't too many surprises relative to what we thought going into the meeting. Obviously, the Fed is right now on hold, so there was no change in interest rates. That was a lock. I guess there was a little bit of uncertainty in the statement. And as we expected, officials took the opportunity, given the backdrop of recent inflation data, to acknowledge that there's been a stalling out in progress. So I think, I don't think it was a slam dunk whether or not they were going to include something with regard to that in the statement, but they went ahead and did so. But I think, with regard to the forward guidance, it still seems like it's the base case eventually that inflation is going to move back down, that they'll begin to cut rates at some point. But I think the real message was we're here higher for longer. And that they're in no rush to begin an easing cycle just yet, given the backdrop on inflation.
Has that changed the way that you're thinking about the Fed's reaction function, I suppose, for the rest of the year and through next year?
Yeah, so our call, which we made not that long ago, assumed that the Fed would start to cut rates in September, and then again in November, and then once more in December, and through most of next year. But at this point, we got some kind of disturbing inflation news last week, and we were all well aware of the core CPI being a particularly bad one from the Fed's policy perspective, and having officials gain confidence that inflation is going to move back down to their 2% objective. But surprisingly, we got the PCE data, which normally you have most of the data inputs that go into that index between the PPI and the CPI. But that too in March was a little bit stronger than we assumed. And what was troublesome is earlier months were revised higher. So we saw even more strength than what was initially reported in January. February was pretty solid as well, not quite as strong as January. But a lot of the metrics that the Fed is looking at, like, for example, optically on a year over year basis, you're starting the year off at a higher level there. So unfortunately, we still think that direction of travel on inflation is downward, but it's taking longer than we earlier assumed after seeing that March PCE data. So, yesterday we pushed up our numbers on core inflation in the wake of those data that we saw in the first quarter. And the earlier progress that we expected to see throughout this year doesn't seem to be happening with that new higher base level, that the year-on-year paces are still, for example, in March, which is an actual, it was up 2.8%. And the Fed, I think, needs to see somewhere in the neighborhood of about 2.5% before they can feel confident enough that it's going to eventually get back down to 2%. And with our new revisions, those numbers don't get there anytime soon. So in turn, we're pushing up or pushing out our expectations for rate cuts. So, what we had in September, by then, I don't think there's going to be enough evidence for the entire committee. And I think one thing that Powell, it's not like they're already cutting rates or already hiking rates on the other side, but to start a cycle like an easing cycle or a tightening on the flip side, I think Powell would want to see a really broad consensus view and make sure that everybody's on board. We pushed out another 3 months from September to December, and pushed most of the easing to this upcoming easing cycle that we still think is going to happen into 2025. The Fed often over tightens on the way up and eases more on the way down. But we do think eventually the leadership will get back down to a more neutral rate, which is somewhere in the neighborhood of about 3 or 3.25%. So we think that's not likely to happen until the latter part of next year. So in our profile, we have 25 basis point rate cuts beginning in December and ending basically at the end of next year. Of getting back to that neutral rate of about 3% or so. I still think that September is a possibility, but given our profile now, it just seems like the probably more prudent forecast would be to get a little bit more confidence, and that probably won't happen until the end of this year if we're right.
The market reaction to Powell yesterday took it, I guess, slightly dovish versus expectations, in the sense that he kind of dismissed the possibility that the next move could be a rate hike. He was quite clear that they still think that this is the peak in the cycle, but just that they're going to have to remain at this peak for longer than they perhaps previously expected, for all the reasons that you've been through. How quickly do you think that the market kind of tests that narrative and actually, pushes Powell in terms of the next move could be a hike? Do we just need to get one worrying NFP print tomorrow, for example? We're recording this on Thursday, so listeners will potentially already know the NFP print by the time they're listening. But is it just one strong data print and the market kind of tests the Fed's resolve on that already? Or do you think it's a couple months worth of data before we start to see, leaning back into this idea that actually, hikes might be on the table?
But I think he was pretty clear. I mean, I think he was given certainly more than enough optionality to put that on the table. And he was pretty clear that they think this is the peak in rates. And, in the March FOMC meeting, and he touched on it a little bit yesterday as well, and he walked us through last year, the Fed really missed on the slowing and the deceleration in inflation because of the strength in the labor market that we saw. They really put a lot of weight on the labor market being really tight and the unemployment rate being below 4%, that they had to continuously mark down their inflation forecasts. So they didn't expect inflation to come down as much as it did. Now, they weren't necessarily aware, and the CBO came out with a report not that long ago that marked up the immigration numbers from last year. And that really helped slow the inflation labor supply issue that was there. As we got all these entrants into the US, it allowed inflation to come down and allowed a lot of the demand for labor to be soaked up by this supply, that you didn't have these tensions with the labor market and pressures in the labor market keeping inflation elevated. At these levels, I don't think that the Fed would put a hike back on the table. I think you'd have to see either rents start pushing higher, which isn't the base case given these other data on apartment listing data rents. And you'd have to see something else that's really going to drive up inflation. Maybe wages start to really pick up for some reason, that it would be so worrisome that the Fed would, really change course. I mean, the Fed doesn't like to change course that often. So I think going into yesterday's meeting, it was really premature to think that Powell just pivoted in December and in January and was willing to say, hikes are back on the table. I wasn't surprised myself. I mean, I do think that was a concern among market participants that, that he would potentially signal that. But I think, markets are sometimes imperfect and they overreact, and I think that that was one example. And Powell really, I think, emphasized that he thinks this is at a peak, and if inflation does remain stickier, he made clear that they could just remain very restrictive at these levels, and that over time inflation is going to go lower. I mean, the flip side of how long you may remain restrictive, the impact, if you squeeze an economy hard enough, you're going to get the unemployment rate to go higher, and you're going to slow the economy. Even with all the fiscal stimulus and the outperformance and resilience that we saw last year and into the start of the first quarter of this year, is going to slow the economy. I still think the monetary policy works. It's just a lagging. The lags work differently each cycle, and if you were to start seeing a continued tightening in financial conditions, you're probably going to see a quicker and sharper slowdown than probably what the Fed is inevitably hoping to see.
I think markets are imperfect is something that we should all remember. And it feels like this year more than ever, they've been quite imperfect. Okay, thank you, Kevin. That was a great lowdown on what we're thinking in the US.
But I think next week we're going to hear from the Bank of England, the MPC meeting next week. So Imogen, what are your key thoughts there, and what are you looking out for next week?
Yeah, I mean, the UK, I think, has taken a bit of a backseat this week to the US. We've had nothing sort of note, I suppose, on the calendar. But like you say, Joann, that should change next week with the Bank of England. It is their quarterly forecast meeting as well. So I guess the three things that I'll be watching out for, first of all, are the updates to the projections. Now, as we know, data so far has come broadly in line with the projections that they published back in February. So it's not like the starting point is materially different when we think about their inflation projections. Marginally lower, I suppose, for Q1, but nothing major or significantly so. Of course, there's probably some near-term upside pressure from increase in energy prices, but the major kind of shift, I would say, between now and when they publish their February projections is the change in market pricing for bank rate. We've got at least 50 basis points less easing being priced at the kind of 2 and 3 year horizon, which clearly will bear down on their inflation projections at that point. So we actually have the inflation projections probably being the most dovish part of the meeting next week, with at the 2 year point on the market's implied path, inflation at 2%, and at the 3 year point at 1.5%. Now, of course, remember back in February, they had that inflation number at the 3 year point at 1.9%. And we kind of talked then about the fact that was sort of implicitly endorsing what the current market implied path for bank rate was. And so implicitly that these forecasts we think will be telling you that the BOE thinks that it will deliver more easing than what the market currently has priced in over its forecast horizon, because that degree of easing that the market has priced in will bring inflation significantly below its 2% target at the 3 year point. But that could well be the most dovish part of this meeting. Of course, the other things that we'll be watching for, and certainly what the market will take its kind of cue from in terms of the knee-jerk reaction, will be the vote, which we expect to be unchanged at 8-1. So that Swati Dhingra is still voting for a rate cut, but all other members on hold still. Like I said, that's unchanged from the last meeting. We're very much of the view that although we're kind of think that we're getting closer to a rate cut, the Bank of England probably aren't going to signal that through a sort of incremental shift in the vote. And actually, when we get to the point of a rate cut, that will probably occur with those kind of centrist 5 internal members all shifting their vote from unchanged rates to a rate cut at the same time. So still looking for 8-1 on the vote split. And then in terms of the forward guidance, we're also not looking really for any kind of fundamental sort of dovish shift there. I mean, it will have an incrementally more dovish feel to it, because I'm sure the minutes will reference these updated projections, which, like I say, will have an implicit dovish messaging. But I don't expect them to be shifting the forward guidance to signal a rate cut is any more imminent than what the current forward guidance does.
As you said, the incremental forward guidance that is a bit more dovish. Do you think that'd be a bit of a market reaction to that? So how do you expect the market to react to next week's meeting?
I think actually, given that the kind of key message of the forward guidance will be largely unchanged, there won't be a kind of radical overhaul from what we heard in the previous meeting. Markets actually might be a little bit kind of disappointed to the extent that they might be looking for something a bit more dovish from this meeting. The projections, like I say, will be the most dovish element, but the market has frequently taken its cue from the vote split and from the forward guidance. And if neither of those are changing, then I think this may be a bit of a dovish disappointment, or potentially even a hawkish surprise for the market that still has quite a large degree of confidence that the first cut will come probably by August. For us, I've repeated on this podcast a few times that it's not the kind of timing of market pricing of the cuts that we think is wrong. We also think the first cut will be in August, but it's more about that degree of easing that the market is pricing beyond August. And because we don't expect this meeting to be a kind of fundamental dovish shift in the guidance or in the vote, I don't think that this will do much to kind of alter that market pricing in the second half of the year. And I don't think it will do very much to change the market's perception that, the BOE is kind of more akin, or the BOE's reaction function is more akin to the Fed's rather than the ECB, for example, where we do think that that first rate cut is imminent. So although we eventually think the BOE will ease more than the market's pricing in this year, and we eventually think that a dovish repricing at the front end should also help bring yields down all the way across the curve, I'm not convinced that next week's meeting is necessarily going to be a catalyst for that shift. It's not like the market anyway is looking for a rate cut, but I think it might be looking for more clear signs that the BOE is getting ready to cut rates than we expect them to deliver. And really the reason that I don't think that they're going to be more dovish is it's twofold. A, because they saw what happened when the Fed committed quite clearly in December to thinking that they would be imminently cutting rates. And I think they will, have learned a lesson from that to a certain extent. But also one of the reasons why August has been our long-held base case for that first cut is about waiting to see the kind of Q1 wage data, which they still won't have. And therefore, I don't think that they would want to overcommit or signal too clearly that they think that they have a high degree of confidence that they will be cutting rates ahead of that April wage data. And really, although I think that the market is massively underpricing the BOE's reaction function this year, like I said, that's about the scale of easing rather than the timing of easing. And if the BOE does think that it will, at this point, it expects to cut rates in August, then perhaps now in early May, trying to be too clever and fine tune that rate cut pricing beyond August will actually lead to more policy mistakes than towards more good. August is still 3 months away. There's still plenty of time for them to kind of shift their message in a more dovish direction once they have the data in front of them and they can be much more confident that is the direction of travel.
What about quantitative tightening? Are you expecting any change in that for next week?
This is the first press conference that we will have had since the Treasury Select Committee published its report on quantitative tightening, which they called the Bank of England's decision to do QT a leap in the dark, and published some fairly damning criticisms around the way in which they've decided to do QT and what it might mean for QE in the future, etc. And it's also, therefore, of course, the first press conference that we've had since the Governor and the Chancellor published their response to that Treasury Select Committee review. And there's also been a increasing amount of focus over the last couple of weeks on repo in the UK, where overnight repo has been decoupling quite significantly or cheapening versus SONIA, for example. And that has led to a much higher than usual take up in the Bank of England's short-term repo facility. For those who kind of aren't familiar with the mechanics, I promise not to do a deep dive in money markets, but essentially when the Bank of England started doing QT a couple of years ago, they created this facility called the short-term repo facility, which meant that given they didn't know what the right kind of steady state level of reserves was in the system, i.e. they didn't really know for how long or how far they needed to do QT before they started shrinking the supply of reserves to be less than the overall demand of reserves in the system. They created this facility that would allow banks to borrow reserves in weekly operations in unlimited quantities at bank rate, such that bank rate continued to be the kind of rate of transmission of monetary policy to the real economy through money markets, so that if they were to shrink via QT the supply of reserves below that level of demand, banks weren't having to bid up for reserves in the system, and they weren't having to drive those money market rates away from bank rates. For the last year or so, the take up in that facility has been very low, and then over the last couple of weeks, as repo has cheapened, we have seen another tick up. So I don't expect the BOE to address QT formally at all in the minutes, as they don't usually do outside of that September meeting or the annual review, but I do expect that it could be the attention of a couple of questions in the press conference. So I will be watching out for any hints around two things. First of all, what they expect to do to quantitative tightening, or how they expect to vote on the pace of active sales going forwards in September. My working assumption right now is that actually active sales could stop come September. In the near term, that makes very little difference because the redemption profile is very high over the next 12 months. So almost 90 billion bonds that the BOE is holding roll off anyway, which isn't that different to the total 100 billion that they currently run down. But of course, it will mean that the pace of shrinkage in the balance sheet gets slower over time. The second bigger question, I think, which is probably more important, is what happens to quantitative tightening once the Bank of England reach the level of reserves that they consider to be that kind of steady state level. They've previously given estimates of what that steady state level is, but they've been quite broad. They've changed over time. But I think, a reasonable guess that they have in mind might be around about 500 billion, which is actually where, once you account for TFSME maturities and the passive roll-off in the gilt portfolio, they would get to that level around about the end of 2025. So it's not all that far away that they might need to decide on the kind of long-term future of quantitative tightening. And whilst that's clearly not a decision that they will be making today, it will be interesting to see how Governor Bailey responds to any questions around that, around whether passive quantitative tightening can continue over the long term, and the BOE essentially transforms the interest rate risk that it has on its balance sheet by using the short-term repo facility or other facilities that it might create to continue to supply reserves to the system, rather than having a large stock of gilts on its balance sheet. The governor has previously sort of hinted at the fact that that is his preference. So I assume that is still his kind of working assumption, but I'll be watching in this press conference to see if he delivers anything that might change our assumptions on that. Okay, probably enough on the UK side. So last but not least, over to Europe, Joann. It felt like somewhat of secondary importance compared to all the US data that we had this week, but it did drive some market moves. So we had the euro area inflation data earlier this week, which of course was one of the last kind of key data points ahead of the potential rate cut from the ECB in June. How are you thinking about the trajectory of inflation in the euro area and what that might mean for the ECB going forwards?
As you say, Imogen, I think the European inflation print that came this week was interesting, just because I think it confirmed this narrative that actually European inflation is quite different to the US. The headline print came in fairly in line with expectations at 2.4%. No real moderation from the previous month, given that energy prices are now higher. But I think what was interesting to know from the data is that services inflation, which has been elevated and sticky for the last 5 months, has now moved downwards. I think that really is a good signal, and I think indicates that the trajectory of inflation in the euro area continues to be one that is going towards target and towards 2%. Core inflation similarly has moderated from the previous month. So I do think the overall direction has been fairly in line with expectations. And I think that it only really seals the deal from what we already know, which is that the ECB is quite likely to cut in June. So I think the inflationary trajectory is not really an issue for the ECB. I think interestingly, of course, before at the start of this year, we had quite a lot of questions on whether the ECB would be able to cut if the Fed didn't cut, or if the Fed's reaction function was delayed. And it seems to be the case that now markets have even come to this idea and come to terms with the fact that the ECB will be cutting in June without the help of the Fed. I think also, it's been pretty interesting in terms of price action. US data has continued to drive European markets, even with this euro area print that came in fairly in line with expectations. We've seen ECB pricing move below 75 basis points, so below 3 cuts for the year. And that really has been US-led for the most part. I think if you had to look at European data in isolation, it seems to be more or less be tracking our expectations at the end of last year. So not much has changed on the European front. It just seems to be that US data is kind of driving quite a lot of market moves at this stage.
You also took advantage this week of a slightly quieter week on the European side to see lots of our clients in the city. What were your key takeaways from those conversations?
So fairly interesting. I do think that a couple of things we talked about would be interesting for this conversation. I think firstly there was a bit of a shift in terms of how many cuts are being expected for this year. So previously 3 to 4 seemed more consensus, but now I think a small minority some of the people we spoke to has shifted to more of a 2 to 3 cuts for this year idea. And I personally think that a lot of that has been driven by the US, and I think similar to market pricing, which is now sitting between 2 or 3 cuts. It really has been moved by the US and the US data. Personally, I do find it a bit difficult to play along or to adhere to this idea that actually maybe the ECB does 2 cuts. I do think that once they start cutting in June, it will be one in a sequence of cuts. So I would expect at the very minimum that we see 3 cuts for this year, so 75 in total versus 50. 50 to me would signal some sort of start and stop procedure from the ECB. And I think the data at this point very much confirms the narrative that European inflation is moderating in line with expectations. So I do think there is space for the ECB to deliver that 75 to 100 basis points cut that continues to be our base case. The second thing that people are a bit more focused on now is which meetings we're likely to see the cuts come in during. I think we've obviously heard from quite a lot of ECB speakers of late, who have, especially the hawks, who have noted that they wouldn't be too comfortable with the idea of cutting consecutively through the meetings, just because I think it would push the market the other way around too much, or move the market to be a bit too dovish. So we do think that it would be more likely if they were to skip a meeting that actually July would be skipped. Just as well because the Fed will not be cutting at that point, and our kind of economics views in line with that now as well for the US. So I think that it just allows them to have a bit more time, allows them to balance the risk between the hawks and the doves, and see how the data progresses before further cuts are put in place. So we do think if they are going to skip a meeting, it could be July. And I think obviously a couple of questions about what we think are the key risks to our ECB call at this stage. I think really inflation is the key. The ECB has one mandate and one thing to look after, and that's inflation. So really we need a shift in the inflationary narrative in Europe for the ECB calls to be put off track. The question is what really leads that shift in the inflationary narrative for the euro area. I think geopolitical risks are clearly a big one. If that drives energy prices higher and therefore has a sustained increase in inflation, that would shift the narrative from where we are currently. Wage inflation seems to be a bit off the agenda at this point. I mean, at the start of the year, there was obviously lots of focus on the end May inflation, wage inflation data, and what that means for the June cut. But I think, the indicators such as the Indeed wage tracker, for example, is fairly in line with this idea that wages as well are tracking quite well. And the ECB as well seems quite relaxed about it. They're not really focusing on that data as they were before. So wage inflation has, I suppose, come down as a priority at this stage because it just seems to be going more or less in line with this expectation that it will moderate. The third is, of course, the exchange rate and the implications there. I mean, the exchange rate to us has quite a small impact on the inflationary picture for Europe. And I think, so I do think that impact of the exchange rate on the ECB's reaction function will also be fairly limited at this stage. So, I mean, I think in terms of inflationary risks, I think the biggest risk is obviously a complete shift in the macro framework from where we are currently. And that's, of course, a bit harder to really predict at this point. And I guess I'll just end with spreads. I mean, we talked quite a lot about spreads with our clients. We are positive EGB spreads going into this rate cutting cycle. And I think it is difficult to find a reason, a specific event where we think that spreads will widen. Again, I think it's all about a shift in the macro picture for that widening to happen, given that the ECB cuts are so well telegraphed. And I think the clients generally share that view. The place where people are most negative at this point continues to be France, where, of course, we will likely have a rating downward at the end of the month from the S&P, even though Fitch and Moody's was unchanged last week. So I do think there is still that bearish pressure on France and this general consensus idea that actually France will be the underperformer.
Yeah, that makes sense, I think. Okay, great. Well, thank you both for joining me. Thank you to our listeners for listening in. Just a reminder, if you liked today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks. See you next week.